the nitty-gritties of this reading. As an analyst, you're trying to come up with the value of a company, and that, of course, depends on the future cash flows. Now, when you're looking at the current income statement, you want to find out which items from this income statement are going to happen in the future. So, the future profit of the company is what is going to be a key factor in determining the future cash flows. And from your current profit, when you're trying to figure out what will be the future profit, you need to make adjustments, or you need to remove non-recurring items, which means those items which will not be happening again. So you need to remove the non-recurring items from your current profit, and then come up with an expectation of the future profit. And then in later readings in equity, we will talk about how you use the profit to convert that into cash flows. And this is a concept which will mature over the 3 levels of your CFA studies. But even at your current level, you should be able to appreciate that the value of a company is going to be derived from the future cash flows of a company, which definitely are going to have a huge impact from the future profit of the company, which is something you will try and estimate using the current profit. And why non-recurring items need to be removed is because they are not going to be there in the future, right? So as an analyst, you are trying to figure out, you're trying to estimate the future earnings of a company, and therefore you would like to focus only on the ones which will continue in the future, the items, the income and the expense items which will continue in the future, and the ones that are not likely to continue, you will like to remove them. Secondly, what are unusual or infrequent items? So remember, we talked about the format of the income statement, where we said you have your revenue, then you subtract your cost of goods sold or your cost of sales, and you get to your gross profit. And then from your gross profit, you subtract your selling, general and administrative expenses before you get to your operating profit, or what we also call earnings before interest and tax. But there was an adjustment here as well, which was if there was any gains, we were adding them, and if there were any losses, we were removing them. Now, those gains and those losses, we talked about them, that they are not related to the core business. And I gave you the example that if I am a car dealership, and this is my, let's say, dealership, and I have cars parked here, and my core business, of course, is selling of these cars. But if the land on which my dealership is located goes up in value, and then I sell that piece of land, I shift my dealership to another place, I get a cheaper place, let's say, and I book this gain, and I show this gain on my books, it's just going to be a one-time thing. It's going to be an unusual or an infrequent item, because it's not going to happen again and again. The frequency is going to be low, right? It's going to be infrequent. It's not a usual thing that will happen in my business. It is unusual. The usual thing is that I will buy cars and I will sell cars at a profit. So that's where the revenue and the cost is going to be coming. The revenue will be the sales of the cars, and the cost of goods sold will be the cost of the cars. That's my core business. So as an analyst, you really want to look out for the unusual and infrequent items, and they could be just gains and losses from sale of certain equipment, not your core business, right? Just something on the side. Or maybe there was some case going on and you got some claims from that. Maybe you were restructuring your business, right? Buying or selling some subsidiaries. impairment of some intangible assets. Now, that is a complicated topic. I'll give you a simple example that let's say Facebook bought WhatsApp for $19 billion. $19 billion. Now, obviously, at the time of the purchase, WhatsApp was only worth 500 million. And why that was is because, as you've already studied, that companies are not allowed to capitalize certain expenses. So whatever expenses WhatsApp was doing, whatever business they were building, they were not able to show it on their asset. When another company pays for it and they pay a much higher price compared to what you're showing on your books, then what they will record is something called goodwill. Now, this goodwill will show on the asset of Facebook that they have purchased a company with a goodwill of approximately $18.5 billion, because 19 billion is basically 19,000 million minus the 500 million that it had on its books. So basically the 18,500 million that Facebook paid extra is basically for the goodwill of WhatsApp. Now, goodwill is something you cannot touch, hence it is an intangible asset. Now, hypothetically speaking, let's say the Supreme Court of the United States, and when I say hypothetically, it means that, of course, this is a made up scenario just to explain to you, not a real situation, but hypothetically speaking, that the Supreme Court of the United States decides that Facebook is using WhatsApp data of people, personal data, and then using that to show them advertisements which are tailored for them, and the Supreme Court feels that maybe this is invasion of people's privacy, and it tells Facebook not to do that anymore, right? Which means Facebook paid all this money because they were going to use WhatsApp to be able to get people's data and then show them more appropriate ads for them, customized for them. But if the Supreme Court says you can't do it, now this value on their books, this goodwill, is not going to be worth that much for them, and they will reduce it. So when you reduce the value of an asset, and it's not like depreciation or amortization where this is an expected reduction of the value of an asset because you're using it over the useful life. This is an unexpected reduction, and this is therefore not an amortization. It is going to be called an impairment, right? So an impairment of an intangible asset is also an infrequent or an unusual activity. I'll give you another example. Let's say you are a trucking company, right? And you buy trucks and you provide services of transport across the country. Now, if one of your trucks gets into an accident, that is going to be an impairment as well. If your trucks are driving normally, you will be depreciating them. Depreciation is expected reduction in the asset over the useful life, planned, right? Impairment is unexpected. So if the accident is there, which was not expected, then obviously the asset value will go down and you will impair the asset. So that is where the word impairment is coming from. An impairment of asset, whether it is intangible or tangible, is of course an unusual or infrequent item. Why is this important for us? Because when we see unusual or infrequent items, we, the analysts, need to really dig a little bit deeper. We should not just ignore them. We should dig a little bit deeper into them and try to understand, are they really unusual or infrequent? And let me give you an example of an unusual or infrequent item which actually might keep occurring again and again. So it's therefore not infrequent, it's frequent. So let's say there is an Indian textile exporter and they are exporting shirts or clothes, right? Clothes to Walmart in the US. Walmart, which is a superstore for those of us who don't know what Walmart is. So now, obviously, Walmart sells in the US in dollars, and the Indian exporter has costs in Indian rupees. Their financial statements, let's say we are reviewing the financial statements of this Indian textile exporter, which is in Indian rupees. Now they keep showing, apart from their sales and their cost of goods sold and their gross profit, they keep showing certain gains, which is, you can say, currency gains, which basically means that every time, let's say they sent a shipment for $1 million, and at that time it was 75 Indian rupee to a dollar, right? So they were expecting to receive 75 million Indian rupees. But by the time the payment came through, the Indian rupee became 80 to a dollar, which means they actually ended up receiving 80 million Indian rupees instead of 75. So this 5 million Indian rupees extra was a currency gain because the Indian rupee depreciated or became weak against the US dollar, or the US dollar appreciated. But the question is this an infrequent or unusual thing, or is this something that happens all the time? Because if the inflation in the Indian economy is higher than what it is in the US, then this is a concept you will learn in economics, or you might have already learned if you've if you've seen the videos for economics. But this is a concept you will learn, that if one country has higher inflation or higher interest rate, then they are going to have a currency which will be weaker or becoming weaker compared to another country which has a lower inflation rate or a lower interest rate. And this is the high level rule. Of course, this is a concept you will develop over the 3 levels of your CFA, because currency rates is a very, very complicated area, and there are people who are doing research at a PhD level in how exchange rates are determined. But the point to understand over here is that if the Indian rupee is slowly but surely getting weaker compared to the dollar, so this Indian textile exporter will always be recording these gains. So therefore, this gain, even though it is shown on their books, on their financial statements as an unusual item or an infrequent item, it's not really that unusual or infrequent. So if you are thinking of investing in this Indian textile exporter, you're going to be coming up with the future earnings, future cash flows, then you can probably assume that these gains are going to be happening relatively frequently. Right. Now coming to discontinued operations. Now with the income statement format, with the sales, cost of goods sold, gross profit, then your unusual infrequent items, gains, losses, and your selling, general and administrative expenses, then your operating profit or earnings before interest and tax, then you have your interest, and then you have your profit before tax, and then you have your tax, and then finally you have your net income. This is the format of your income statement. Now, my friends, sometimes what happens is that a business unit has been planned, decided that it will be discontinued. And let me give you an example. Let's say you have KFC in the USA, right, which decides that it does not want to continue business in India, right? So that means if you're looking at the income statement of KFC globally, then if KFC US has decided that they want to discontinue the KFC in India, then they will show it in their income statement that the total income will not show the income of the Indian operations. After that, separately, they will show income from discontinued operations. They haven't been discontinued yet, but because the company has decided that they are going to discontinue these operations, if in advance, even before the discontinuation is done, they will start showing the income from discontinued or to be discontinued operations separately. Because as an analyst, you should know, when you're trying to come up with the future earning projection, you know that India is not going to be there. So in the current income statement, they should tell you if they've decided to, if they have plans of disposing of certain business units, right? Now, it's not so simple, by the way. There's a lot of more detail in this area, and I'll just give you a little bit just for your interest. That if you are trying to discontinue something, it should be geographically separate, right? A company can't just get up one morning and say, oh, I'm going to have a discontinuing of operations of certain business unit. Either it should be geographically separate, or it should be uh, a separate business unit. Like, for example, if we take another example, like let's say Pepsi obviously has a lot of businesses, right? They have their drinks, their soft drinks business, and they also have snacks like Lay's. So if Pepsi decides that we're going to have a discontinuation of the business of Lay's, then they can do that as well because it's a separate business. So geographically separate or separate in terms of the business line is a requirement for a company if they want to discontinue something, that it should be something identifiable. Number one. Number two, the company should be serious about doing this. They should have taken very, very serious decisions, not just having plans to dispose of. They should have taken serious decisions, informed their management at all the important levels that we have taken this decision of discontinuing it, and then they have to show it separately. Another important point over here is that this is shown net of tax, right? So the income is not going to be earnings before tax, it will be earnings after tax. So this will be the net income portion of the Indian operations. That will be shown separately. And on their balance sheet, so whatever balance sheet, let's come back to the KFC example, right? On their balance sheet, whatever assets they have in the Indian branch or subsidiary, they should be marked separately, and whatever liabilities they have in the Indian subsidiary, the assets, the liabilities, they should be marked separately, that these assets and liabilities are also going to be discontinued, so they're going to be sold and settled. Now, why is all of this important for us? We as an analyst are going to try and predict future projections, right, for the company, its income from the current ones. So when you're doing that, naturally the discontinued operations you will have to exclude because they're going to be discontinued. Okay, so that's done. Now moving on to a little bit different topic within your income statement. And this is not just something that impacts your income statement, this is something that impacts your financial statements. Remember when we told you that management has a lot of discretion, there is a lot of room for judgment in accounting. That is why as an analyst you have to be very careful when you're analyzing financial statements. And two major things which you have to be very careful of is estimates and policies, because this is something that the management can choose. For example, when we're talking about inventory valuation, there are multiple choices available in terms of accounting policies. You can have first in, first out. You can have last in, first out. IFRS doesn't allow that, but US GAAP allows last in, first out. And you can have weighted average, right? So the point is that if a company is doing first in, first out, and you're in a period of inflation where prices are going up, so the expensive inventory which they are receiving first in is being sold first out, right? Compared to that, if a company is doing last in, first out, so they're selling the cheaper inventory first, the old inventory first, which was at the lower prices. So if you're selling the cheaper inventory, you will have higher profits. If you're selling the more expensive inventory, you will have lower profits. So the profitability can be impacted by the choice of inventory valuation method, which is a choice of accounting policy, right? If they are going to do this, if the company is going to change the accounting policy, this has to be updated retrospectively. What does that mean? This means that not only do they have to update this year's financial statements, they have to go back and update all the financial statements which they are showing with the updated version of the accounting policy, as if that change was there from the past few years, right? So they have to update it retrospectively. Now, if they're having a change in estimate, and let me give you an example of an estimate as well. Let's say they bought a factory machine, right? And they had an estimate of useful life of 10 years, right? This was their estimate. Now, if they are changing that estimate to, let's say, 20 years, naturally, the cost of this factory is going to be now divided across 20 years every year, and the depreciation expense will be lower, profit will be higher. So this is something that is definitely going to impact their profitability. But the question is, do they need to go and update the past years? The answer is no. Changes in estimates only have to be updated prospectively, right? So this is your changes in accounting policy and estimates, right? And estimates. If there is a change in policy, it has to be done retrospectively, which means they have to go and update the past records as well. Otherwise, if it's just a change in an estimate, you can do it prospectively as well. And that is what is told over here, that for changes in policy, it is retrospective. Example, going from LIFO to FIFO. And for changes in your estimates, right, it is going to be just prospective, which means the previous years are not changed. An example over here is the useful life of a depreciable asset. Okay, what if you made an error? You're not changing a policy, you're not changing an estimate, you just made an error by mistake. Genuinely, it was a mistake and you realized it later. Right. Obviously, if you're realizing it within the current year, you don't have to change any past years because the error is realized within the year of the financial statement. So you can just fix your financial statement within that year. But if you have made an error in a previous financial statement, now obviously you're going to have to fix that. Right? How will you fix it? So let's say this is 2024 and this is 2023. And I realized that I made an error in my 2023 financial statement. My profit I declared as $100 million. Actually, it was $99 million. So this is the mistake I made. So what should I do? Now, in my 2023, I had my income statement, my balance sheet, my cash flow statement, my changes of statement of changes in shareholders' equity. Right? Now, one item that is there in your balance sheet is your equity, right? And if the profit was lower, so if I had recorded a profit of 100 million, my equity would have gone up by 100 million. And I would have shown that in my changes in shareholders' equity as well. But actually, my profit didn't go up by 100, it went up by 99. So I just have to minus 1 from my equity, right? Show that change in my changes in shareholders' equity as well. And that's it. That's the only change I need to do. So in my 2024 financial statements, the opening balance of my equity account, right, is just going to be adjusted by minus $1 million. That's it. That's the only change you need to do for a correction of an error. Just adjust the opening balance of the equity account. Obviously, if a company is making errors very often, that definitely does not give a good sign to an analyst. All right, and the modified retrospective approach is similar to what we just discussed, that let's say you're having a change of accounting policy and you're required to go back and update all your financial statements retrospectively. An easy way out is that instead of doing that, just adjust the opening balance of your equity account. So this is, you can say it's like an approximation to the the retrospective application, right? It's like a hack or a lazy version of the retrospective application, that instead of actually going and updating your past financial statements, you're just adjusting the opening balance of the retained earnings, which is obviously a equity account. All right. So I think we're going to stop this video here, and we'll pick up the next one from on here, which is earnings per share, because earnings per share is a very, very, very important area of your CFA level 1 studies, and we're going to dedicate a video to it.